Vikram, let's take this conversation forward because I understand that Foram Parekh, who is a fundamental analyst, India Bulls Ventures, is joining us. Foram, thank you for being part of this show today. Just your quick take on the markets as well as, top bets you have at this stage in the week. Foram, good afternoon. Just wanted to start with really what the market is looking like for you, as well as the top trading strategies that you recommend for the week.
Yeah, so we feel that market has undergone a very good correction, and this augurs a very good buying opportunity for both, mid caps as well as large caps. We have seen Q2 earnings panning out to be quite decent, and we have seen corporate earnings growth coming in, after good 7-8 quarters, and this recovery we feel is there, to stay for a very long time. Hence, first we should look at large caps, and amongst the large caps also we feel that FMCG sectors have seen a good volume growth of 8 to 10%. So that augurs a very good, pocket for good 10-15% earnings in a year's time. Also back in the international market, if we see out of the G20 summit, we have seen that the biggest tension between the US and China trade wars has been de-escalating, and that also augurs a very good positive sentiment. Also crude has been stabilized at $60 per barrel. Of course the OPEC outcome meeting outcome is yet to be there, but we do not foresee crude going back to more than $75 per barrel. Hence we feel that macros are quite positive. Crude is stabilized, rupee is appreciating, bond yields are in control, and that is why with good corporate earnings as well, macros and micros looks really stable at the current juncture. Hence one should definitely look to buy for a long-term perspective, and of course in a staggered manner.
Foram, at one level, it's contrary to some of the views that we've been getting here on BTVi, that perhaps a deeper correction is still expected in the markets and the volatility is going to stay until the outcome of the 2019 general elections is not known. But you believe that the markets are very nicely poised for a bigger upside. But you did mention the Indian rupee and how it's been appreciating. Of course, the headwinds as far as in the past is concerned, those seem to be behind us, and now the IT sector, which really got the tailwinds from the depreciation of the Indian rupee. Now, is that going to change the picture for them? That's what I want to understand from you, because the IT sector today, if you take a look at it, 1.5 percentage point up move, and you're seeing it move about 28 to 30 odd percentage points over a year-to-date period. I'm talking about the Nifty IT index. So it's done significantly well for itself, and perhaps the depreciation in the Indian currency has helped its cause. But what does the future hold, even as we look at an Infibeam, which is leading the charts in gains today with gains of over 7 odd percentage points, or an Infosys, Wipro and NIT Tech, which are gaining over 2 odd percentage points each. Do tell me, since you said that perhaps there are opportunities both in the large caps as well as the mid caps, how would you pick and choose within the IT sector if you think there are big upsides left here?
Yes, as you rightly pointed out, Nifty IT index, has been doing very good, and there is of course a rupee appreciation factor also. Rupee appreciation would definitely, dampen the margins, but I do not see it dampening the margins in a, positive manner. So the biggest, benefit for the IT sector is most of the companies are doing very good in the digital revenue space, and most of the companies have more than 25% of their revenues coming from the digital revenue. So I feel the transformation from the traditional business to the digital business, the phase is over, and now it's time to reap the benefit out of the digital business, and that's what we are seeing right now. And the fact that large cap IT sector, large cap IT stocks have undergone a steep correction also post their results. So I feel that from here on again, there is more cap for 10 to 15% upside. I would like to go, my pecking order would be first TCS and Infosys out of the large cap IT space. From the mid cap IT space, I would definitely want to go and buy Mindtree and Zensar Technologies, NIT Tech. So these are the pockets which looks really good. Now we need to look at companies which are not only in the US market, northern markets, but also like for example Zensar Technologies. This company is doing good in the South African region also, and not just in the BFSI segment but also in the retail space. So we need to look for pockets, which are not just in the traditional BFSI segment. Hence, Zensar comes out as a very good play, and any correction in Zensar Technologies augurs a very good buying opportunity for good 10-15% upside. Hence, I feel that of course Q3 would be a seasonally weak quarter because of festive seasons and lesser working days. But the utilization rate is also improving for most of the IT companies. Most of the IT companies are able to get good deal wins. In case of Infosys, we are seeing the retention of its old clients also. So these are the pockets, TCS, Infosys from the large caps that you can still buy for good, 10-15% upside for 1 year's perspective.
Okay, let's move away from that for a minute and focus on the big story the market is buzzing with. This is the latest at SunPharma, because the management has addressed concerns over McCary's report, really calling the issues either unrelated, very old, or factually incorrect. But what is the stance that brokerages have on this particular counter? Let's focus on that story for a moment, and getting in my colleague Abhishek Ranjan, who's standing by with more. Abhishek, what is the latest, and how are brokerages really interpreting the latest developments or the news really that we've seen around SunPharma?
We are picking up Jefferies and Citi on the development, and both of them in fact say that while the news itself, the issues under consideration is quite dated and in public domain, they still believe that the stock might have to deal with certain overhangs in the near term. And if you talk of Jefferies in particular, well, they have retained a hold rating on the counter with a target price of rupees 535, which implies an upside potential of 17% from the current market price. And they have clearly said that the management responses, the clarification that management tried to put out may leave market with mixed feelings. And why they say so, they have in fact brought out an instance wherein they're saying that management refrained from full disclosure on the $300 million plus dollar loan in advance in FY18, and that will make the market a bit unsure about the developments in SunPharma. As far as the valuations are concerned, they believe that valuations are still broadly in line with the peers, despite the stock's current corrections that they've witnessed. Valuations are currently at 20 times the FY20 reported PE, and despite the corrections, the kind of valuations that's being quoted, they say that the risk reward is not overtly favorable. Moving on, if you look at what Citi has to say on SunPharma, well, they maintain neutral and also the target price at rupees 575. Again, kind of upside potential that they're seeing is to the tune of 25% as far as the target price is concerned. And they again go on to say that overhang to continue till there's more clarity, and they do not see a meaningful business impact from most of these issues that is being talked about.
All right, even so, the stock is down by about a percentage point. Abhishek, many thanks for walking us through what the brokerages are saying. There are mixed views coming in on SunPharma. But be that as it may, today if you look at the pharma pack, it's up about a quarter of a percentage point. Besides SunPharma, Glenmark and Lupin are also taking it on the chin. But Divi's Lab and Cipla, like I mentioned, besides the Biocon, are holding things up within the pharma space. But talking about SunPharma, we had a chance to speak to Nimish Mehta as well, who's the founder and director of research at Delta Advisors. And they're saying that they should remain pretty confident of the company's long-term business performance and not look at the short term. And these events, they say, do not necessitate a change in their call on SunPharma. Listen in to what we heard from him.
The name and the nature of the company to which they have done this transaction is not disclosed, which is why there is some amount of anxiety about what this is all about. That might be an overhang on the stock. I mean, that might go away only if the performance improves and all of those things. The business-wise performance is something that we feel positive about SunPharma on a longer-term basis. I personally don't feel that there is any need to review it because of the allegations. There is not much to actually change the inherent value, so to say. I mean, 20x would be a very cheap price for anybody to get into.
Okay, so we've been trying to really get an idea as to how different investors are really looking at SunPharma. I just want to come back to my guest on this. Foram, is this just a really tough spot or a bit of a cloudy spot for a SunPharma? I mean, how are you interpreting the latest developments, as well as, I guess, any opportunities when you see with regards to this counter?
Well, if you see, SunPharma has been lagging, since a very long time. And of course, there was a rumor yesterday that we seen of, corporate governance issues. But then nevertheless, I feel stock should be as an avoid at current juncture, because we have seen the entire pharma space correcting. And there are many pockets within the space which are doing better than the SunPharma. SunPharma needs to be wait and watch approach because of the HUL plant and everything. So I feel that people, investors should still wait for a couple of quarters to get a clarity. And one can shift towards Aurobindo Pharma or Jubilant Life Science or Dr. Reddy for that matter, because these are the pockets that have done fairly well in their quarterly earnings. For example, Jubilant Life Science, if we see this stock is been doing very reporting very steady numbers since a very long time, and has been growing at good 10-15% on a top line. And also this is a stock that does not face much of the US FDA regulations issues. So we want to go for pockets which do not have more of US FDA issues, and that is why we are very confident for Jubilant Life Science from the pharma space over SunPharma.
So definitely wait and watch for SunPharma. This is not the dip that we are seeing in the stock. Foram believes is not an opportunity to buy. You need to wait it out and perhaps even move away from SunPharma if you're invested over there and look at a Jubilant within the pharma pack that she sees merit in, besides of course an Aurobindo, which remains your pharma sector bellwether. Meanwhile, let's see what brokerages are saying about the FMCG pack, and the big merger that we've seen within that space is of HUL and Godrej now joining hands. We're talking about GSK. Brokerages pretty upbeat on HUL on the back of this merger with GSK Consumer. The counters, both of them are trading flat in trade today, but yesterday we've seen HUL seeing its highest intraday gain since the year 2013. We have Shefali joining us to tell us what brokerages are making of this merger, and especially about HUL. Shefali, what exactly are you hearing? Because it sounds like a positive, really, despite the kind of valuations that this deal has gone ahead with.
Yes, absolutely. A couple of brokerage houses have actually upgraded the HUL stock, starting with Edelweiss. They are maintaining the buy rating on the counter, and they have a target price of about 20-30 rupees on the share. They expect global parentage support to increase with higher revenues, a contribution to Unilever. They're expecting EPS accretion of about 4.5% in FY20. They expect margins for the F&B business to improve by about 180 basis points to about 17.8%, and they expect the double-digit revenue growth in GSK consumer healthcare's portfolio in the near term. So that's Edelweiss. Citi also has come out with a view. They are maintaining their neutral rating on the counter with the target price of about 1660 rupees per share. And also management has clarified that there is no arrangement with GSK on the liquidation of 5.7% stake. It'll be interesting to see how HUL uses the stock as a currency to purchase an asset from here on. And HUL is going to continue a distribution agreement for GSK Group's OTC oral. So that was a part of the announcement. Of course, company sees room for gains due to its customer development capabilities. So a couple of synergies out there. Credit Suisse came out with an opinion. They're also maintaining the neutral rating on the counter with a target price of about 1900 rupees per share, and they're saying that FY21 will be the first full year for the merger, and they've lifted up the FY20 EPS estimates by about 6.5%. CLSA came out with a view. They're retaining their outperform rating, and they've actually increased the target price to about 2010. and they're saying that the deal values GSK's business at about $4.5 billion, a slight premium to yesterday's close, and the deal is valuing GSK's assets at about 31 times 1 year forward CLSA EPS estimates, and even without any synergy benefits, the deal is EPS accretive for HUL. That the deal would add around 6% to HUL's EPS, and GSK PLC intends to trim its holding in HUL post deal, but no further details are available, and they've given some sensitivity analysis that every 1% change in GSK's margin adds about 0.5% to the combined entity's EPS. So, and that is on top of the 5% upgrade that that's the brokerage house has done. So interesting view coming in there. Deutsche Bank also put out a note. They've also upgraded the stock to a buy rating versus a hold rating earlier, with a target price of about 2100 rupees per share, and they are seeing the deal to actually be margin and EPS accretive by about 5% in FY20 without even building in any synergy benefits, and they're saying that HUL will unlock significant synergy scale and synergy benefits on costs and the revenue front. And the last on the list is Jefferies, and they're saying that the deal is accretive, but the execution will be the key thing to look forward to from here on, and it may add about 800 to 1000 basis points synergy as far as the margins are concerned in a phased manner. 6 to 9% EPS accretion is what they see for the company going forward. They are valuing the stock at about 45 times FY21 PE, which leaves no room for error from here on. And then they're maintaining the hold rating on the counter with a target price of about 1650 rupees per share. So out of all the brokerages, that's one of the most conservative target prices, and on the higher side we have target prices coming in excess of about 2000 rupees per share.
All right. Thanks very much, Shefali, for walking us through what the brokerages are saying. As far as the merger is concerned, there are definite upsides on HUL, and they're very upbeat about it. Foram, what's your own understanding? Do you think that profits and margins can be strongly impacted with this merger, because HUL within the FMCG pack has always been a bellwether, but you know, as far as moves go, as far as the stock is concerned, there hasn't been anything that phenomenal. But now with this merger, which is touted as one of the largest within the space, do you think there are major upsides for investors?
Yes, I certainly feel this deal is very positive, and it can be EPS accretive. If you look at Complan itself is a very itself is a very strong brand, and acquiring this brand would give a good brand in its kitty for HUL. And again, if we see it will get synergies of, HUL has good distribution network, and with the help of its distribution, it would be able to penetrate Horlicks as a brand very good, and management itself has guided for a good upside in the food and refreshment segment. Now this segment contributes I think 15% of the total revenue, and this segment would be growing at good in double digits, so which would be definitely very much EPS accretive. And looking at the brands that the company has in its portfolio and the ones which it has acquired, which itself is a very strong brand, we feel current valuations are justified, and that is why one can definitely look at more than 2000 rupees on the share.
Okay, fair enough. Those are the kind of levels you feel are reasonable for an HUL. But I want to just focus a little bit on a Maruti, because we've been seeing how that's been actually trading flat. This is after the sales misestimates in November. HSBC, I beg your pardon, has maintained its positive outlook on this counter with a buy rating, although it also has cut the price targets from 9,000 to 8,700, and that's because they're citing weak market trends as well as market share going down. Monica is standing by with more on this. Monica, what are you picking up at this stage, and exactly what has gone behind the kind of movement when we've seen at the brokerages?
Well, HSBC believes that Maruti's flat year-on-year dispatches in November is not a big disappointment, as the street had already lowered expectations on heavy news flow of a weak festive season in the past few weeks. According to them, the car demand has been softening through the year, and the November retail was not very strong as well. But despite this, HSBC believes that Maruti remains one of the most compelling long-term auto stories in India. Though the near-term demand trends are worrying and may lead to short-term stock volatility, but the recent strengthening of rupee and weakness in commodities have reduced the downside risks to margins for Maruti. Well, HSBC believes that discounting may remain elevated, especially in the month of December, as volume traction remains weak in the short term. Thus, they are cautious over the near term and have cut Maruti's volume growth expectation by around 300 bips for FY19. Well, they have also revised the earnings growth estimates by around 5% for FY19-20 and have cut the target price to 8,700 rupees from 9,000 rupees. But the target price does imply a 14% upside from the current levels. Well, the brokerage has maintained the buy rating despite a cut in target, as they remain positive on Maruti's ability to regain and maintain market share and drive growth over the long term. Though despite the positives, HSBC has mentioned some of the key downside risks for the stock. According to them, Maruti can face higher than expected market share losses due to new competitive product launches. Also, weak product launches by them could negatively affect the company's brand. On the other hand, higher than expected deterioration in the macro environment or an increase in discounts could materially impact HSBC's profit expectations for the stock. And lastly, any further increase in commodity prices and yen appreciation will also impact their estimates.
Okay, thanks for taking us through all of that, Monica. I just want to understand from Foram, how do you look at what we're getting out of the brokerages in terms of a Maruti? Because one could actually look at the kind of target price that's been mentioned over here. Do you think this is the right kind of range that we're looking at, as well as any kind of picks you think are good ones to make when it comes to the autos?
Yeah, so talking about Maruti, if we dissect the automobile sales numbers, of course, the Alto and the mini segment haven't done that good, but the SUVs are doing good and is showing a growth. And we have seen that the new product launch has been done in the SUV segment. Hence, we feel that, one should definitely buy Maruti at current market price. Of course, it is difficult for Maruti because of a higher base, of 1.5 lakh units. It's not able to sustain. But nevertheless, we feel everything is discounted in the current valuations. We have seen commodity prices also stabilizing, and that would also lead to a margin increment. And being a market leader and retaining its market share, I feel Maruti should be a buy at current market price for the target price of 8,500 for 1 year. Also, if we look at the entire auto pack numbers which have come out, two-wheelers have been able to do good. We feel that Bajaj Auto remains our top pick from the two-wheeler segment. Of course, there are problems in the international markets, and that is why all the companies' exports have been, impacted. There is election year going in the Sri Lanka region, and that is why we have seen, exports of Ashok Leyland also being impacted. But also, if I look at, Ashok Leyland from the commercial vehicle space, the demand itself in our home country is immense for infrastructure, and that is why demand for commercial vehicle will continue to be there in a year, for 1 or 2 years. And looking at the financials, the Ashok Leyland has reported and the valuations it is trading at, I think valuations have discounted all the negative aspects, and that is why from the commercial vehicle space we continue to remain bullish on Ashok Leyland for the target price of 125 for 1 year. From the two-wheeler space, we continue to like Bajaj Auto again for good 15% upside, and from the passenger vehicle space, we have a buy call on Maruti for the target price of 8,500.
All right, so as far as the auto pack is concerned, you've got your picks down to the T. As far as November sales are concerned, those were a downer. So whether that pain is going to last or not, that remains to be seen, especially for passenger vehicles and for a stock like Maruti, which has really ruled the roost when it comes to the entire space. But going ahead from here, Ashok Leyland, whether commercial vehicles are going to play that catch-up game, and stocks like Ashok Leyland, whether they are not going to deliver, that remains to be Foram Parekh, thank you very much for joining us with your perspectives on this edition of Markets Midday. Meanwhile, we've learned here at Business Television India from top government sources that the Road Ministry is likely to get 83,000